Hey guys, how's everyone doing? Can you all hear me okay? Awesome. I'll move this chat a bit. Doesn't really need to be here, but I like having it. Could remove this annoying YouTube message. I think it'll disappear soon. So, how's everyone doing? Welcome to State of the Strategy, second one for the 2018 period. I know it's 2019, but I had a horrible December. I've said this before, but I'll just go over it again for those who don't know. Start of December, I got a cold or a flu while I was in Belgium for the birth of my first nephew, or technically speaking, my partner's first nephew, but I guess it's my nephew too. So I got a cold. Then when the cold cleared up, I went for a run, sprained my ankle. Then when my ankle started to heal, which is still not fully healed, I got bronchitis of all things. And my December was pretty much from being sick to being injured to being sick. And also the first week of my January. Therefore, we're not going to do 3 State of the Strategy webinars this year like we do every year. We're only going to do 2. This is going to be the second and final one. I don't think it's going to be that... you're not missing out on much, essentially. You're not missing out on anything, really. And we're doing webinars throughout the year to make up for only 2 State of the Strategy webinars. Thing is, State of the Strategy webinars only really make sense at the end of December and at the start of the trading year in January. Because I wasn't able to do them towards the end of December, it just doesn't really make sense anymore. They're not really going to be that useful if I do. It won't be useful if I do one more after this one. So we're going to do this one. We're going to wrap them up for the year, and we're going to be doing other long webinars throughout the year. Beyond the analysis webinars that we do weekly, we're going to be doing other long webinars throughout the year, and those webinars should be we'll be covering new topics and new things. So hopefully that makes sense. Hopefully that's okay. And today's webinar, what are we going to discuss? Well, first of all, we're going to discuss how to master Forex in the new year. Now, I did a webinar on this recently it was a public webinar, so that's for everyone. That's not members only. This webinar is members only. This one's going to be a little bit different, but overall, we're going to be discussing the same concept. That's just going to be the first part of the webinar, though. So if you attended the public webinar, you may have already seen most of this. Not exactly. There's going to be some changes to it for you guys. But then the second half of this webinar, we're going to be talking about entries. Trade entries. I'm just going to be clearing up some confusion that I've noticed on the forum, specifically about retrace entries, but we're also going to be looking at other entries, and more importantly, I'm going to be answering questions on trade entries. That's the main thing I want to do, answer questions on trade entries, because it seems like there's a lot of questions. It's one of the most common questions I am asked. Trade entries, people ask me about them, if they're entering at the right spot, blah, blah, blah. So I thought that's a good topic for this webinar. So we're going to kick things off with how to get started trading in the new year. And then we're going to dive straight into trade entries. How's that sound, guys? Does this sound good? We all okay with that? Any objections? Any questions? I'm going to move the chat so you guys can see the slides. Bring the chat back later. Still got a little bit of a cough, guys, but it's mostly cleared up by this point. So do excuse me if I do cough a little bit. I can't really control it. Can't really mute this microphone easily, so you're just going to have to put up with it. I'll try and move away from the mic if I do have the urge to cough. Okay, let's get started. So, like I said, we're going to be discussing how to get started trading in the new year. Now, for me, this is the first week I'm getting back into trading for the new year. I was looking for some trades last week, towards halfway through last week. That was mostly because I was bored and I just wanted to start trading again. I told myself at the end of November or midway through November that I would restart trading on the 14th of January. But when it got to the 7th, I was like, oh God, I haven't traded for like 6, 7, 8 weeks. And I'm just so bored doing nothing now. So I started looking for trades on Wednesday. So technically, I've already started trading for the year, but this is my official start, the 14th of January, today. I've been looking for trades today, and things are going back pretty much to normal. So I thought makes sense to also tell you guys how to get started trading in the new year, what to do. Now, I know some of you have already started trading, technically speaking, but it doesn't really matter. You can implement this plan this week, even if you started trading last week, okay? It's not that important that you implemented it last week. But the point is, I think everyone here should implement this plan. Now, you might be thinking, well, what if I've been trading for 3 years already and I don't really need to implement a plan like this? Doesn't matter. I've been trading for 17 years. Wait, is that true? Yeah, 17 years. And I still do this. Now, I do it slightly differently because I've got a lot of experience. I'm going to give you guys a slightly modified version of this plan that's more applicable to newer traders with a few years or less under their belt. But, everyone should follow this plan. This plan is the most logical way to trade. And I'm just going to get into it and explain it, right? So we're going to start with step one. Step one, pick your setups. Now, in the strategy, there are multiple types of setups. There's reversal setups, there's continuation setups, there's compression setups, and there's a few other types of setups. And more scalping setups are going to be coming soon. The compression setups can be used on the 5-minute chart for scalping. There's going to be more scalping setups coming soon this year, which I'll be releasing soon. So you can trade all setups if you want to. You don't have to pick a specific setup. You don't have to pick scalping. You don't have to pick just reversals or just continuations. It just totally depends on you as a trader and what you want. If you have a lot of time free, you can focus on scalping shorter time frames. If you don't have a lot of time, if you're a very busy person, you might want to focus on daily chart trading, reversals, and continuations. I can't really answer this for you. Ultimately, it's up to you what you choose. You can also just try all of them at the start of the year, see what fits your trading style. And if you can handle trading all the different types of setups in the course, then go ahead. That's awesome, because that's going to give you a lot more trades, a lot more experience much quicker. But for some of you, it's certainly going to be too much, and you're going to want something on the longer term where you can take, a few trades per week instead of a few trades per day. Totally up to you how you approach this, but the important thing is that you pick your setups and you clearly define in your trading plan what setups you're going to be trading for the first 6 months of this year. So you just need to make that decision. If you're struggling, what I would suggest is to just pick all the setups and then eliminate some of them if you find that it's just a bit too much for you, right? Hey, Giovanni. So yeah, pick all the setups and just eliminate some if it's too much for you. I think a lot of you will find that trading the shorter time frames, so 5-minute, 15-minute, is just going to be a bit too much for you, and you're going to want to eliminate those. But like I said, start of the year, if you want to, and if you think you can handle it, pick them all, and then just eliminate the 5 and 15 minute if you find that it's just too much work for you. So step 1, to start off the year, pick your setups. Okay, pick your setups from the strategy. Any questions about that? Or that one makes sense? I assume that it makes sense and that it's easy, but if there are any questions, feel free to ask. Just gonna, the reason I'm silent is I'm just waiting to see if there's any questions coming in. If there's not, I will continue. With these members webinars, I don't mind having questions in the middle of the webinar because it's a smaller group, and you know, you guys tend to not ask silly questions that would take us off subject. You guys are all smart enough and respectful enough to keep it on track, so I don't mind doing questions halfway through. You asked about picking setups, Giovanni. Well, I guess George has already answered it, so you don't. You probably don't want to ask it, or don't need to ask it here. I mean, cool. So pick your setups. That's step 1 for the year, guys. Okay, next, get an account. Now, most of you are already going to have an account. I'm just adding this step for those who don't. Get an account. Now, when we're talking about getting an account, there's 2 different types of accounts, obviously demo and live accounts. I don't need to explain this to you guys, but what I do want to explain is the kind of differences in terms of psychology between these accounts. So demo is low risk, or I don't know why I wrote low risk there. Technically speaking, demo is no risk. You're not risking money, but it allows you to learn. So there are huge benefits to demo trading. Now, a lot of people don't like demo trading because they feel that they're not making any progress financially. But to be completely honest with you, if you're trading live and you don't know what you're doing and it's your first month of trading, you're probably going to lose some money anyway. So there is no reason not to trade demo if you're just starting out. Now, if you've got some time under your belt and you're already going for a live account, that's completely fine. And to be fair, live accounts for some new traders are better than demo accounts, because there are some new traders with the mentality that if it's demo, they just don't bother. You know, they're not motivated to trade a demo account because they're not getting anything out of it. And if that's you, if that's how you feel, then that's fine. I mean, you don't force yourself to trade demo if you know that you're not going to care about it at all, right? If live account is the only way that you will actually be motivated to trade, then go for a live account, but do keep the money in that live account a small sum. Do not put in, you know, all of your trading capital into a live account when you're just starting out. That is completely irresponsible. Doesn't matter if you own the course. The course isn't a magic pill that's going to make you a super profitable trader in the first month. You know, you still have to go through a learning curve. No matter if you have the best trading mentor on the planet, it doesn't matter. You are still going to have to go through a learning curve. And that first month, maybe even the first 2 or 3 months, are going to be rocky. So don't go full on with your live account. It's up to you what you choose, demo or live. Demo is going to be good for a lot of traders simply because it allows you to have 0 risk, but you can still learn. For those of you who aren't bothered trading demo, you just don't have the motivation, go for a live account, but put a little bit of money in there. If you can afford 500, I would say go 500, because 500 allows you to take most trades. When I say take most trades, what I mean is there is a minimum amount that you can put in per trade. Oanda is a broker that has, I think, the lowest minimum. But even with Oanda, if your stop is big enough, the lowest amount you can put is the lowest amount you can put in a trade is going to be bigger than your maximum risk. So let's say your stop loss is 200 pips, for example. The lowest amount you can put with a 200 pip stop is going to be more than 1% of your account, which would be your maximum risk, if that's your maximum risk. So live accounts, when we're talking live accounts, I would suggest put at least 500 in there. And if you can't afford 500, 200 is okay, but you might find that you are not going to be able to take some trades on fast moving pairs like GBP, JPY, for example. You might find that you're not able to take trades on pairs like that. Ultimately, it's up to you what you choose. You can ask me for advice if you want. Now, one final thing for accounts, different accounts for different strategies, right? Or for different setups, really. Now, you can keep the same account for reversals, continuations, compressions on time frames above 1 hour. So if you're doing compressions on time frames above 1 hour, keep the same account. Or maybe even 30-minute, but that is the absolute minimum. Once you start dipping below 30-minute charts, you are now in scalping territory. If you are scalping, it is better to have a different account for your scalping. If you are swing trading, so that means the 200 SMA setups, if you are swing trading, it's best to have a different account for your swing trading. The reason for this is, number one, it allows you to more easily track data for the different strategies, because these are different approaches to trading. So it more easily allows you to track track things. But there's another side to this. If you're swing trading, right, you're holding a position open for weeks, and sometimes even months. Now, let's say you're in 2 swing trades, and each swing trade you've risked 1% of your account, for example. Now, that means 2% of your account, of that account, is already wrapped up in swing trades that are going to be open for a month or 2. Now, you're also taking day trades from that account. Now, you open 3 day trades, 4 day trades, let's say. That's 4% of your account, plus the 2% open on swing trades. So now you've got 6% risked at one time. And now you're also doing scalp trades from that account, and you've got 3 or 4 scalp trades running at any one time. So we're getting close to 10% risk at one time on a single account. That's not how you trade. That's not a smart way to trade. So having different accounts for different strategies is very important. When you're doing scalping, have a separate account for your scalping and for your day trading, and for your day trading and your swing trading, have separate accounts. Might be annoying, but it's just the best and cleanest way to do things, guys. Let's move this over here. Giovanni is saying, this is the reason I asked about setups. My theory is that if I take 50 trades, objective using all the setups, my expectancy is not going to represent how good I am at specific setups. That's exactly right. Now, you can't have different accounts for all setups. That's just not really feasible. So that's why I split it up into scalping, day trading, and swing trading. So your day trading should all be in one account. That's probably going to be your main account. That's how it is for me. My day trading is my main account. My swing trading is kind of like a secondary. My scalping is a secondary account. But the bulk of my trading capital is in my day trading account, because that's where I do most of my proper trading. Scalping is, it depends if you trade the 30-minute. Some people don't trade the 30-minute, but if you trade the 30-minute, then what I would say is anything below the 30-minute chart is scalping. So not including 30-minute. 30-minute and above is day trading. Anything below 30-minute, so that's most likely 15-minute and below, is scalping. And the definition for swing trading, that's also daily chart. Daily chart is classed as swing trading and day trading, in my opinion. But it just comes to different kind of setups. you don't really differentiate day trading and swing trading by time frame. You differentiate it by type of setup, because some day trading setups you're going to be holding for months. So probably easiest way for me to do this is to write it out on the forum. But anything below 15-minute, anything below 30 minutes, so that's usually a 15-minute chart, is the lowest you're going to go below 30-minute, because no one really trades 20 or 25-minute charts. So anything below 30-minute, scalping. Anything 30-minute and above, so 30-minute and above all the way to daily chart, is day trading. And then swing trading is the 200 SMA setups. That's the only swing trading that we do in the group. Make sense? Any other questions about this, or? All right, it doesn't look like there's any questions, so we can move on. So just to summarize, demo or live, up to you. Demo is no risk, and keep different accounts for different strategies, or just keep different accounts for scalping, day trading, and swing trading. Cool. Step 3, define your risk. This is a simple one, guys. Set your risk to 1% per trade. Once you gain more experience, you can start toying with this. You can drop it down to 0.5% on risky trades. You could bring it up to 1.5 or even maybe 2% on very safe trades. You can mess around with your risk once you have some more experience, but especially if you're new to trading, just go for 1% and stick to it. Look, you're just here to learn at the moment. Obviously, I'm talking to people who are new in this case. If you are new, you're just here to learn. So you don't want to be risking too much. You just want to kind of ease yourself in to the risk management game, and then start messing around with your risk when it's time. So I would say go for 1% risk per trade. Just keep it simple, and don't mess around with that risk too much. Target 1 to 2 on average. So what's 1 to 2? That's just your risk to reward ratio. So your stop loss and your target. Your stop loss is represented by 1, your target is represented by 2. So that ratio simply means your target is twice the size of your stop loss. When I say on average, that means that not every single trade your target has to be twice the size of your stop loss. You might do 1 to 1.5 sometimes, and sometimes you might do 1 to 3. But the average, you want to target 1 to 2. You're not always going to meet this target at the end of the year or at the end of the first 6-month period, but that's your target. Normal or Nirmal, I'm not sure how to say your name. You're just learning. I mean, if you're learning on a live account, or why would you be setting your risk at 5%? You're at a stage where you're learning. You are going to make mistakes. You don't want to make mistakes when you're taking big risks. That's why. If you're beyond the point where you're learning, if you're more comfortable with your trading, if you're more comfortable defining your own risk, then, do so. But while you're learning, it's best to stick to a low risk, because you're going to make mistakes, and you don't want to make mistakes and cost yourself, large percentages of your account with every single mistake you make. Your mistakes are going to hurt you less if you have 1% risk per trade. Fair enough? 1% risk is good. It just depends on. It depends on the trader and it depends on their situation. There's going to be some traders with small accounts whose main objective is to grow their account because they only have like a $500 account and that's the max that they can afford to put in. Now, you might find that those traders want to risk a little bit more in order to grow their account. And if they have enough experience and they have a good enough track record, they might be okay to risk more. 1% is personally what I like to risk, but my account is big enough that 1% is something that I can comfortably, the money I make from 1% risk is enough for me to, comfortably live off of, live from, off of, what? Live from. So, it's a very situational thing how much you're risking. 1% is pretty much the standard in Forex. But there's nothing really to say that you can't risk more than 1%. Now, I know when you look on Google, people are always going to say risk only 1%. But, that's not really accurate. It's a really situational thing. If you want to risk more and you have the experience and you know what you're doing, you can risk more. It's just situational. But while you're learning, 1% is a good place to start because you're not gonna you're not gonna have your mistakes aren't gonna have a huge impact on your capital. Nirmal, does that answer your question? And Ian, does that answer your question? Nirmal is no longer responding, so I don't know, I'll just move on in that case. All right, so step 3, define your risk. That's done. Step 4, set a trade goal. So in your first 6 months, you want to go for either anywhere between 30 to 100. 30 is the bare minimum. 50 is at 50 or above is optimal. So you want to go for 50 or above if you can. Now, it might be hard in your first 6 months to take 50 trades. If you're trading only the daily charts, you might not be able to get that goal. Just do your best. If you get only to 30, that's okay too. That's acceptable, but 50 and above is optimal. So you need to set a trade goal. Do what you think is best. If you want some advice, feel free to email me and ask me. Let me know a little bit about how much time you have to trade, what time frames you want to focus on, and I can help you set a trade goal. But yeah, 30 is usually achievable for most people, even if you don't have that much time to trade. 30 in 6 months is definitely achievable for most people. If you can get 50, that's going to be awesome because that's optimal. If you can get 100, that's even better because that's more data. The more data you have, the better. Now, what you want to do is journal every single trade. I'm going to link you guys to a trading journal. A trading journal it's essentially just a spreadsheet. You're not going to be writing, dear journal, today I took 5 trades. That's not what a trading journal is. Trading journal is a spreadsheet, and the spreadsheet allows you to basically record information that goes beyond what your broker allows you, or what your broker logs for you. There's a difference between a trade log provided by your broker and an actual trading journal. A trading journal is a different thing. It's a way more in-depth thing. It's going to take you a little bit of time to fill it out, but that's just the reality of trading. It takes time. You can't trade without investing time. So if you're too lazy to fill out a trading journal, then you're probably never going to get anywhere with your trading. If you're too lazy to fill out a trading journal, you're probably not going to get anywhere in life because you can't invest 10 minutes to better yourself. I mean, it's just something you have to do in order to improve. It's a very minimal amount of time for each trade. It really doesn't take that long to fill out a trading journal. Don't be lazy, do it. Now, the reason you want to fill out a trading journal is simple. This tool, this simple spreadsheet, allows you to improve your trading consistently. I still use one of these. I've been trading for 17 years. I still use these. Gunther is asking an important question. Do you journal at the end of the day or right after each trade? Do you also recommend trading a single currency pair during the first 6 months? All right. The first part of your question. I fill it in before, during, and after the trade. Some stuff you can fill in before. Some stuff before you enter. Some stuff you can fill in during, and some stuff you can only fill in after. But I actively fill it in as the trade is going. I don't fill it in at the end of the day. There's important questions here that pertain to trading psychology, essentially. How do I feel about this trade? How do I feel in general? Are you? The phrasing on that is not, am I in the correct frame of mind for the trade? That's better. Am I in the correct frame of mind to trade? These questions you can only really answer as you're taking the trade. If you answer this at the end of the day, you might have already forgotten how you felt in that moment. And these questions are important things to answer. You want to use mostly keywords for these. Don't use, don't put your life story. How do I feel in general? Don't put, oh, today I had a fight with my wife, so I don't feel. We're not looking for stuff like that. We're looking for keywords. Keywords or one single word, and try to keep them consistent throughout the year, because that way that allows you to highlight them all at the end of the year. If you put tired, like throughout the whole sheet in your first 6 months, then you can highlight all the rows that say tired later on. And you could see how trading when tired affects your trading, for example. If you put tired and then you put sleepy, and so you put tired and sleepy mean the same thing, right? So if you put tired and sleepy, two different words, then you can't really highlight all the trades that you took when you were tired, because you have different keywords for them. So use consistent keywords throughout. It's all about consistency with keeping a spreadsheet, because at the end of the day, it's data. When you have 200 trades in here, the best way to sort through this data is to use formulas on the spreadsheet. Now, if you don't know how to use that, it's very simple stuff. You just Google it. I can help you out with that, of course. You can post to the forum. People on the forum will help you out. Don't worry about the formulas for now. That's something that you can do later. And there's so many guides to formulas that allow you to highlight all the rows that have specific keywords in there, blah, blah, blah. But my point is, let's say you have 200 trades in here. If you have all kinds of weird definitions to how do I feel in general, then it's going to be really hard to filter it. So stick to keywords. Happy, bored, tired, just pick a few keywords that describe your feelings and stick to those keywords. Do not change them. Yeah, all webinars are recorded. I've never done a webinar that's unrecorded. Right, so Gunther, journal as you're trading. That's very important. Do I recommend trading a single currency pair for the first 6 months? Definitely not. That's going to mean that you're going to take like maybe 10 trades in 6 months. Depends, obviously, what you're doing. If you're trading smaller time frames, then you might get away with it, but probably not. If this was 2007 and you were asking me that question, I would say most certainly pick GUP JPY, because that's going to give you like 20 trades a day. But markets have changed. 2019, one currency pair is not going to get you anywhere. I'd recommend at least 10 currency pairs to get enough trades. Nikki, do you think it's better to use some automated trade journal so you can have statistics calculated for you? Maybe. I personally have tried a lot of different trade journals, and I find that the stuff that I want to calculate is not always calculated, and the best way to do it is to just do it myself. If you find that you're happy with trade journals that exist out there, like Edge Wonk, it's a weird name, but Edge Wonk, that's a pretty popular trading journal. If you find you're happy with trading journals like that, then go for it. I personally find that it's better to just do it myself because it allows me to create formulas that give me all kinds of data. I actually have an updated version that I'm going to be releasing just to you guys. It's going to be for members only, at least at the moment. It's kind of like a super trade journal. Let me see if I can find a copy of it. I haven't finished working on it, so it's going to be released later this year. But you can copy and paste most of the data over, so it won't be that big a deal. Let me see if I can quickly find it for you. I just want to show you guys a demo of it. Where did I put it? Damn it. One sec. I want to show it to you guys because it's really cool. No, that's not it. I think it might be called Trade Tracker. I think I can find it now. I think I remember yeah, I think this is it. Right. Here it is. Yeah, I'm working on this new journal for you guys. I'm gonna work on it a little bit throughout the year. Last edit was 31st of August, so it's been a while. But it has like a settings tab. The settings allow you to there's going to be a few more settings, allow you to set some important information. There's going to be a stats tab. Calculations tab is going to be a locked tab that you shouldn't really change anything in here. But see, it's going to have like charts that show you your days with most trades, your best risk to reward ratio, your worst risk to reward ratio, which is not calculated properly clearly, but I'll figure that out. But it has all kinds of information. So this one's going to be a little bit better, and it's going to have drop-down tabs that allow you to more easily pick the things. That way you are kind of forced to use the right keywords, like yes and no's for this, blah, blah, blah. So yeah, this is a slightly better version, which I will be releasing. And then you could just copy most of that info over pretty easily. No, I wouldn't just log the trade score, but there should be somewhere to log the trade score actually for those using the points tool. So that's actually a good point. I didn't ever think to add that, and I will add that. Blue K Nibs, definitely a good idea to record demo trades. You need to record that. You need to record every trade. Doesn't matter. Nikki, that's something that we go over in the course, and you are using a percentage. You're not using a fixed amount of pips. The only time I would ever use a fixed amount of pips would be on scalp trading, but you know, just yeah, use. Well, I mean, for your stop, you're using price action to place your stop, and then you get your stop size based on price action, and then you adjust the size of your trade to be a set percentage of your account. It's not something that we're really going to discuss today, as it's a bit too in depth, but it's covered in the course, and you can of course email me or George for more information on that and how to calculate your stops. But it's not really what we're here to discuss today. So yeah, we can't go over it, unfortunately. So you're going to set a trade goal. You're going to journal every single trade. I'll link you guys to the journal. I'll update the new journal. I'll update to the new journal ASAP. That way you guys can have some more info. And most important, stick to your strategy until you hit your goal. Now, this is where most new traders screw up. They start with a strategy. They have like 5 or 6 losing trades in a row, which is perfectly normal. Losing streaks are normal. It's part of trading. And then they're like, oh, this strategy is not working out for me. I'm going to switch to a different strategy. And they'll switch to a different strategy. It'll work out well for a few months. Then they'll have 6, 7 bad trades in a row. And then they'll be like, oh, this strategy is not working anymore. And then they'll skip and they'll go to another strategy. Blah, blah, blah. And it goes on. And then they never get anywhere in their trading. 2 years in, they're like, well, nothing's working for me, so I'm going to give up on trading. That's because you don't stick to your strategy. Stick to your strategy until you hit your goal. Because you're going to find that sometimes you will take 6 losses in a row, but then the next month you might take 7, 8 wins in a row. And when you're taking 7, 8 wins in a row, you're going to feel great. And more importantly, you can't really expect to make a crazy amount of profit in the first 100 trades you ever take. Nikki is asking a question, which I kind of was about to get into that. The goal of us recording our trades is so that we can see our performance and we can spot things that are wrong with our strategy or with our personal approach. Because generally speaking, it's more your personal approach to the strategy and not the strategy itself. So the reason we're tracking all this data, the reason we fill this in, the reason we are not lazy and we fill this in is ultimately because it's going to allow us to identify what's wrong with our trading, especially the stats screen, which doesn't exist in the current version of the trading journal, but it's going to exist in the new trading journal. The stats screen is going to allow us to uncover things that are wrong with our trading and adjust them. But they're also going to allow us to figure out what's right about our trading and adjust that. So this is an incredibly important tool. And to answer Nikki's question, how do you know when a strategy has stopped working and needs adjustment? That's what the trading journal is for, because it allows you to identify when you're making mistakes, when there's something wrong that needs adjusting. That's the whole reason of keeping a trading journal. It's not just about what's wrong with your strategy. It's about what's wrong with you, what's wrong with your approach to trading, what's wrong with like all kinds of things. That's what it allows you to do. So that's step 4. Step 5, review and improve. So you review your performance, you see what you did right, you see what you did wrong, you make changes. I kind of already spoiled this step because we were just talking about that. So step 5, you use your trading journal, you look at all the all the trades, you look at the stats. Now, you're going to have to calculate the stats on your own in the current version of the journal. When it gets updated, you're going to have all kinds of handy stats on this tab. But in the current version of the journal, you're going to have to calculate the stats on your own. It's really not that hard to calculate. Like I said, we can help you on the forum. We can help you one-on-one via email. Just email me and I'll help you out with the calculations. Calculations are not that difficult. And once you get used to it, it's all pretty easy. And like I said, the new version of the journal is going to do most of the hard work for you. So you don't have to worry too much about that. Right, so any questions about this so far, guys? It sucks that you lost connection, man. Is it YouTube or is it your internet? The webinar is being recorded anyway, so you can watch the recording. How do you stay motivated on course when you're on a losing streak? It's kind of hard for me to answer that because I've been training for so long that I know that when I'm in a losing streak, it's just a normal part of my trading, and I just kind of keep trading through it. So yeah, it's a tough one for me to answer because personally I can just trade through it. I think you're better off asking George about that, Nikki. George is always there to help, and he has more experience with being a new trader. I mean, I was a new trader 17 years ago. So it's hard for me to remember back how I felt 17 years ago when I was in the middle of a losing streak. But George started trading, what, 4 or 5 years ago? 4 years, I think. So George is in a much better position because he remembers what it was like and he can help you kind of get through that. So I would strongly suggest emailing George about that. I mean, that's what he does. He's there to help. So yeah. Yeah, actually, that's a good point, Giovanni. One of the ways that I know helps is just knowing what to expect in terms of losing streaks. So once you know what to expect in terms of losing streaks, it's a lot easier to get through losing streaks because then, then you know what's coming. So in the trading tools section, there's a tool for you guys. It's members only tool, or losing streak calculator. Now this tool allows you to see, let's say over your first, I don't know, how many trades do you plan to take in your first 6 months? Now I did say 50 to 100, but let's say you're scalping just for the sake of it. Let's say you're scalping and you can manage 200 trades. So boom, you got 200 trades. Your win rate or your strike rate is 50%. That means you win 50% of your trades. That means you're going to have 8 losing trades in a row in your first 200 trades. But it's also possible for you to have 13 losing trades in a row. 70% win rate. Let's say you're an amazing trader, one of the best traders ever. Because 70% win rate on your scalp trades is a tough thing to do. But let's say you can manage that. Even with a 70% win rate, you're going to have 4 losing trades in a row, but you could have up to 8. It's statistically possible for you to have up to 8. Once it gets beyond 8, then there's probably something wrong. But 8 losing trades in a row with a 70% win rate is statistically possible. So this losing streak calculator, it allows you to see how much you might lose, and or it allows you to see what's statistically normal using probability mathematics, what's statistically normal for you to lose, and knowing that ahead of time is kind of a good way to prepare yourself for that. Because then when you're in the middle, let's say you have your first 100 trades, you have a 60% strike rate, you're 4 trades into a losing streak, you use this tool and then you know that it's normal. It's normal for you to have a 5% losing streak in your first 100 trades. If you were flipping a coin and it's a special coin that's going to land on heads 60% of the time and on tails 40% of the time, it's likely that it's going to land on tails 5 times in a row if you flip it 100 times. It's just probability mathematics. It's just how things work, how the world works. So knowing that ahead of time helps you. Right. Are there any other questions, guys? If you attended the webinar that I did last week, which was very similar to this webinar, but it was for the public, this webinar has a lot of differences that are tailored specifically for members of the course. So I hope that those of you who attended last week's webinar weren't too bored in this one, because we have discussed quite a bit of different stuff. So yeah, I hope you weren't too bored. We are going to be talking about entries for a little bit, but we are fast running out of time. So we should get a move on to that stuff. Actually, I'm not even sure how much time we have in order to discuss entries, guys. This went a bit longer than I thought it would, and I need to get out of here in about 15 minutes. How shall we do this? Should we hold a separate webinar on entries? That way I can cover it properly. Because, all right, I have about maybe 20 minutes left. Maybe I could stretch it to 25 minutes, but much more than that is not going to be possible today. I don't think that I could do this subject justice in 25 minutes. Now, I could really just try to rush through it and explain as much as I can, or we can hold a separate webinar next week maybe, and we could discuss entries in that webinar, and we could do the subject justice because we'll have a good hour to discuss it. Do you guys think that's a better idea, or do you want me to just rush through it now? I'll leave it up to you guys, but please make your responses very quickly, because if I have to rush through it, we're running out of time. I obviously personally think that doing a separate webinar would be the better course of action. We got 3 people saying next week. I think that's better. But we still have about 15 minutes. So how about we do questions on entries? If you guys have questions on entries, we can do them now. So like questions on entering trades. And, you know, that actually is pretty good, because that will give me maybe some extra talking points for next week's webinar. Or maybe we'll even just do it later this week, because it is Monday, so I might be able to just fit it in on Friday or something. Yeah, you know what? I think I can do it on Friday. I'm just looking at my schedule. It's pretty clear. I think Friday evening we'll do a webinar on entries. But yeah, if you guys ask questions about entries now, that might give me some extra stuff to talk about on Friday evening. I mean, support resistance and entries kind of go together a little bit. So if you have a question on support resistance, just feel free. Gunther, there's going to be some more info on 5-minute scalping. I don't know. I don't want to put a date on it, but I'll just say soon. There will be a webinar on it at some point. If there's any questions, feel free to ask now. Sorry guys, I didn't think it would take as long to run through that stuff, but you guys asked me a lot of questions, and they were all really good questions, so I wanted to answer them. So we ended up spending about an hour just going over the stuff that I thought was going to take, 20 minutes to get through. You could also ask questions on entries, Gunther. The basic rules for entries, yeah, sure. We'll definitely have enough time to go through that. Now, it is sort of dependent on the setup you're looking at, but let's look for a quick example. Does anyone know of a reversal setup forming at the moment? I know of one, but it's not that great of an example. It's Euro New Zealand, because it's pushed up quite a bit, so it would be very tough to enter that one. Yeah, there, Euro USD, maybe lower time frame, yeah? Right, cool. So Euro USD, we're seeing, I mean, it's not a great setup, but it's an okay setup. What time frames are already triggered on? I don't see it already triggered on any time frame, really. Oh, maybe the 4 hour. Yeah, the 4 hour, it's already triggered. I probably wouldn't have entered this one. This is actually a good example of something we can talk about in terms of entries. Now, I assume that, Giovanni, you've entered on the break of this candle here, right? On the 4 hour. Hopefully that is a correct assumption, but and I'm going to make a note to expand on this subject. All right. Your SR was over. Yeah, the SR is... maybe your SR was here. Let's just leave the SR there for now. Let me just put down a note for something that I want to discuss in the webinar that we'll probably do on Friday. So I'm just going to write this in my notebook, so just give me a second, guys. Sorry, but it's just taking a second because it's a hard one to explain properly in my notes. I've found that if I don't note things down and I just keep the idea in my head, I'll often forget about it, so it's better to just write it down. Uh, 14th of Jan. Alright, cool. All right, so what I wanted to discuss here is a mistake I've often seen people do, excuse me, with their entries in regards to using the high of indecision candle to enter. So now our most basic type of entry is very simple. What we do is we look for indecision, and then we look for a break of the high of the indecision candle. And if we're looking for a long trade, of course, we look for a break of the high of the indecision candle, and we'll put our stop loss below the low of the indecision candle. So this is the most basic type of entry. And it's generally a pretty okay entry, but it's kind of like the minimum. And a lot of people seem to think that the minimum entry is always your goal entry. That should be what you always go for. So the minimum entry is above the high of indecision by a few pips, no exact amount, but usually you're looking at 3 or 4 pips above the high of the indecision candle. This is the indecision candle. That's the high of the indecision candle. The entry is above the high. Now that's the minimum entry you want. Now minimum is not a goal. There's a difference between, like a minimum is just a minimum acceptable entry. Now, what situation do you use the minimum in? You usually use the minimum in a situation where your next support area is really close by and you want to get a 1 to 2 risk reward ratio, and you can't get that if you use anything less than the minimum, right? You can only get a 1 to 2 risk reward ratio if your entry is here. If your entry was all the way up here, you're now going to get a very bad risk to reward ratio. So in that case, you would use the minimum because it allows you to enter this trade and maintain a decent risk to reward ratio. But your minimum is not your goal. When you have more room to breathe, like in this case where the next resistance area is all the way up here, when you have more room to breathe or more room to maneuver or more room to trade, let's say, you can use a better entry. You can use a safer entry, not necessarily better, but safer. In my eyes, safer is better, but you know, some people who aren't as cautious as me don't necessarily think safer is better, but I'm just going to stick to that word, safer entry, better entry. I'm going to stick to that. So a better entry in this specific case with this trade here would be above the high of these candles here. So above the high of these candles here. Because these candles, these highs, they represent a barrier. And when you want to enter a trade, you want price to get beyond barriers. Now, the first barrier in this case is the high of the indecision candle. That is the first barrier. If you can get above the high of the indecision candle, awesome, that's good. But there is another barrier, and it's beyond the high of these candles. That's the second barrier here. So there are 2 barriers here. If price can get above both of those barriers, then it's a much safer trade. And with this setup, because the next resistance is up here, you got a 3.2 almost risk reward ratio if you use your minimum entry. That means that you have more than enough room to pull your entry all the way up to there, stick your stop loss down here, and you know, put a target here, and you still have over a 1 to 2 risk reward ratio. So in this case, you're going to want to put your entry further up because it's a much safer entry. You're going to sacrifice some risk to reward ratio, but you're going to get a much safer trade. You can even extend your stop loss down for a safer stop. So your minimum is not always your best bet. Your minimum can be used when you've got tight confines and you just want to get into the trade anyway because you think the trade has a good chance of success. Then you can say, okay, I'm going to stick to that minimum entry requirement, which is a few pips above the high of indecision. I'm going to stick to my minimum stop loss, which is a few pips below the low of indecision. But this is never optimal. This is just your minimums. What's optimal is usually going to be beyond the minimum. Average true range. Honestly, I'm not that familiar with the indicator itself. It's not something that I use, so I'm not even sure. I hate saying this because a lot of people judge you when you say this. I don't really know how this is calculated or what its use is. Now, the reason why I hate saying stuff like that is because people think, oh, well, you've been trading for 17 years. How can't you know this? But I don't use the indicator, so I got really no idea what the average true range, how it's calculated, and what it does. So I can't really answer that question. Could you give me some insight into what it does? In the meantime, I'll Google it. There's essentially a moving average. It's a simple moving average. Or not a smooth moving average. Of the true range values? Oh, interesting. How would you use this to help you judge entries? Honestly, Giovanni, this is not something that we can really get into in the webinar because I feel like this would be a longer discussion. But if you want to email me some of your ideas around this, we can discuss it via email, and then possibly we can move that discussion to a webinar or to the forum if we can find something useful there. I'm definitely open to using indicators that are genuinely helpful in trading. I've not really found that many indicators that help. I find that they usually just kind of get in the way and they cloud my judgment. But I'm always open to experimenting and to trying indicators. As far as I can tell, and as far as you've said, this is basically just a moving average. So I'm not 100% sure how it can be used in order to determine entries. But yeah, just email me some ideas and we can have a chat about it. Michael Standen, that is a very, very good point. If you are considering on entering a pair that has already moved most of its average daily range, then you might not want to enter, and that's a good point. I calculate the average daily range for pairs to kind of get an idea of the move. Actually, I've got it open now because I was doing it recently. I think this is a GBP USD one. We could see the average daily range for GBP USD per year. So this is basically the average, the daily range of every day of the year averaged out. See, in 2008, it was insane. 2016 was pretty high in comparison to most years. And 2017, 2019 is pretty much the average for GBP USD. We're talking about the same thing? Or are you talking about just the average daily range? I have one of these for all pairs. I like to keep an eye on what the Forex market is doing in terms of how it's moving, how much it's ranging in comparison to other years. So 2017 was quite low average range, but 2018 it picked up again a little bit. But yeah, I find this pretty handy. So GBP/USD moves around about 110 pips on average per day as of 2018. So if GBP/USD has already moved, 150 pips on that day, then it might not always be a smart idea to enter a trade on GBP/USD because it's already moved it's already moved above what it moves on average. So it's unlikely that it's going to move a whole lot more on that day. But, that's only a very small factor in deciding if you're going to enter a trade, because the reality of the market is, or the reality of averages is, they are just averages. There are going to be days that are well above average. So it's only a small factor in deciding whether or not to enter. It's not one of the main factors. Guys, I'm enjoying this conversation, and I think we're covering some kind of important stuff, but I think we're going to have to pick it up on Friday's webinar, because I'm running a little bit late already. But yeah, email me what you were thinking, Giovanni, because I'd like to chat about that further. I'm going to wrap up this webinar, guys. We did talk about entries a little, but not as much as I wanted to, of course. On Friday, I'm not sure on the time yet. It'll probably be a bit later than this webinar. I think it'll be about 7 p.m., maybe 6 p.m. UK time. So that would be 6 p.m. It's 6:13 at the moment UK time. So it would be around this time, or 45 minutes after this time. Around then we'll discuss, we'll do a webinar on entries. Just to go a little bit more in depth into entries. And yeah, tomorrow we'll be doing just a general analysis webinar that we're going to be doing every Tuesday, Wednesday, Thursday this year. Well, I'm not going to say every single one. Obviously, I'm going to be on holiday and stuff throughout the year, but most of them. So yeah, thank you guys for attending. Those of you who are attending tomorrow's analysis webinar, I'll see you guys tomorrow. And those of you who are attending Friday's webinar, I'll see you guys on Friday. And of course, I'll see you guys on the forum throughout the week. Yeah, Nikki, I email a link for all the webinars. You'll get a link tomorrow. So yeah, thank you guys for attending, and I will see you later.